Good morning. It's Friday, the 17th of January, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming, as always, from Mumbai, India's financial capital. The top stories and themes on this cool Mumbai morning. Markets gain on interest rate outlook and positive fund flow cues. Infosys results and guidance suggests US banks will up spending on the back of strong performance. Refineries are scampering to buy crude as sanctions on Russian oil take hold. Hyderabad is running out of beer as United Breweries battles with the state government of Telangana for past dues. And India's trade deficit conundrum, decoding the numbers.
This is the Core Report with Govindraj Ethiraj.
Indian shares hold gains on Wall Street cues. So the supply signals are a little stronger than they were a few days ago, the key one being US interest rates, which are likely to be cut now, given that inflation appears to be under control there, or at least the perception that it is, after softening in December. Wall Street zoomed on Wednesday on that count, and the market overall is well poised there. Here, stocks rose on Thursday, led by financials and tracking other global markets as well. If there are more Federal Reserve rate cuts, as are being expected now, that is good for capital flows into emerging markets like India. Traders are now pricing in 2 Federal Reserve rate cuts in 2025 compared to 1 after strong labor market figures last week, according to CME FedWatch Tool, reported by Reuters. Back home, signals are somewhere between weak and mixed right now, with Q3 earnings or third quarter earnings likely to remain subdued, except, or rather with some exceptions, and we'll come to that. It must also be noted that even if companies do well, that could be because of many other reasons, including cost management and not any specific uptick in demand, which would give the economy more comfort, and the macro numbers are not yet showing that. Riding on Wall Street, the Wall Street ended positive for the third consecutive session on Thursday. The 30-share sensex was up 318 points to settle at 77,042, while the NSE Nifty 50 was up 98 points to close at 23,311. The broader markets did better than the benchmarks, with the Nifty Mid-Cap 100 and Nifty Small-Cap 100 indices ending higher by about 1% each. On Wall Street, overnight stock futures were a little changed after Wall Street notched its best day since November on Wednesday, thanks to that tame inflation report and, of course, blowout bank results. S&P futures, NASDAQ 100 futures, and Dow Jones Industrial Average futures were all flatlining. The financials are ruling the roost on Wall Street right now. Bank of America shares were higher after the company reported earnings and revenue better than the previous quarter. Shares of Morgan Stanley were up after it posted strong fourth quarter numbers for both top and bottom line, thanks to strong investment banking activity and fixed income trading revenue. And this was on the back of other bank majors like JP Morgan Chase and Goldman Sachs, who also beat fourth quarter estimates, according to CNBC. On Wednesday, Dow Jones was up about 700 points, and the NASDAQ and the S&P were up quite sharply. Back home again, Infosys, the country's second largest software exporter by revenue, reported a roughly 11% year-on-year increase in net profits to 6,800 crores for the third quarter. And that beat consensus Bloomberg estimates, which were around 6,773 crores. Sequentially, net profits were up 4.6%. Revenue was at 41,760 crores, up 7.6%, exceeding consensus Bloomberg estimates of 41,353 crores. Sequentially, revenue was up 1.9%. More significantly, Infosys raised its revenue guidance for the financial year 24-25 to 4.5% to 5% in constant currency. So, which means that it's increasing its revenue guidance in dollar terms. As we know, the dollar is very strong and the rupee has depreciated quite sharply against that. Now, this is an upward revision from the 3.75 to 4.5% guidance provided by Infosys for the second quarter, that's July to September of the current financial year, that's 24-25. Now, this is the second time Infosys has revised its guidance. In Q1 or the first quarter, it had said it would grow at 3 to 4%, and this revision reflects an increase in both top line and bottom line, which would suggest that growth momentum has picked up. And the other big results announced yesterday, that's Thursday evening, were Reliance Industries, which reported a 7% year-on-year growth in its consolidated net profit at about 18,540 crore. For the third quarter, revenue from operations increased 7% to 2.43 lakh crore rupees. That's 243,000 crore rupees. The profit beat street estimates of about 18,337 crores, while revenue was also higher than expectations of about 1.39 lakh crore rupees. So both top line and bottom line were slightly higher than street expectations. The oil to telecoms operating profit measured as earnings before interest, tax, depreciation and amortization was up about 8% to 48,000 crores in the reporting third quarter, and margins were up to 18%. The strong growth during the quarter, and we will analyze this a little more over the weekend, was led by a healthy show from all the key businesses of Geo, that's retail, and particularly the oil to chemicals, where refining margins recovered sequentially, according to the company. Indian refiners are scampering for crude. And here is our energy segment supported by the India Energy Week. All the action right now is around Russian crude and the challenges of that crude reaching the biggest consumers and their refiners, that's China and India, and of course the uncertainty of supplies. Right now there's a scramble for new crude sources, thanks to which crude prices are also up, having hit about $82 a barrel or so, and now back to about $81.46 a barrel. Reuters is reporting that Indian Oil Corporation is seeking high sulfur oil from the spot market in its first SAR crude import tender since March 2022. Expecting the latest United States sanctions to hit supplies from Moscow, which hits a couple of producers as well as 183 containers or tankers ferrying crude. Indian Oil and other refiners have boosted purchase of discounted Russian oil after Western entities, that's Europe and America, imposed sanctions and shunned purchases from Moscow over its invasion of Ukraine in 2022. Besides looking for SAR crude, the Indian Oil has issued a separate tender to buy sweet crude for loading between Feb 16th and March 15th, sources told Reuters. The tenders close on Thursday. Spot premiums for Middle East crude have risen to their highest in more than 2 years on Thursday on strong demand from China and India, while tanker rates have also soared, according to Reuters. This segment was supported by India Energy Week 2025, scheduled from February 11th to 14th, 2025 in New Delhi, and you can register for the same using the link in the show notes. Did a DJ bring down Adani's nemesis? Hindenburg Research, the nemesis in many ways of organizations like Adani Group and individuals like the Securities and Exchange Board of India chairperson Madhavi Puri Buch, is shutting down. In a long goodbye note, Hindenburg Research, based out of New York, and its founder Nate Anderson have said, or rather he said, that a British DJ or disc jockey called Lee Burridge, who plays in Bali, had a big impact on him at a pivotal time. He quoted several personal reasons and some professional ones, including broadly the fact that their job was over and the pipeline exhausted. He said that if you're chasing something you think you want or need or are doubting whether you are enough, take a minute and give this a listen. It had a big impact on me at a pivotal time, he wrote as a postscript in a long goodbye note on the Hindenburg Research website with a link to Burridge's video on YouTube. And obviously, if you do a Google search, you can find both, which is the goodbye note as well as the video. He said that there was no specific one thing, no particular threat, no health issue, and no big personal issue. And he, in his letter, posted on Hindenburg Research's website on Wednesday, the intensity and focus has come at the cost of missing a lot of the rest of the world and the people I care about. I now view Hindenburg as a chapter in my life, not a central thing that defines me. Anderson, by the way, is 40 and caused a stir in January 2023 when he published a report accusing Adani of pulling the largest con in corporate history. So presumably, like it was a chapter for Hindenburg or for Anderson, the whole episode was a chapter 2 for Adani and SEBI. Hindenburg, by the way, has gone after several other companies, most of whom have seen several sharp reductions in their net worth and value at that time. India's palm oil imports. India's palm oil imports could fall to a near 5-year low in January thanks to negative refining margins as buyers move to more competitively priced soy oil, sources in government and industry told Reuters. A government official told Reuters that about 110,000 tons of palm oil was cleared in the first half of January, which is a small amount compared to the usual monthly imports. Now, the larger problem, of course, is import duties, which have been increased to protect domestic farmers, because of which edible oil prices in India have shot up, contributing to higher food inflation as opposed to earlier, where actually it was keeping it down. India imported an average of more than 750,000 tons of palm oil every month in the year ended October 2024, according to the Solvent Extractors Association of India. Refiners are apparently incurring losses of more than $30 a ton in palm oil refining for January shipments, and the oil is available at even lower prices for February and March, according to traders. Soy oil, which traditionally commands a premium over palm oil, is now offered at a discount to palm, according to traders, and buyers are therefore moving to soy oil from palm oil, and this would continue unless palm oil corrects and becomes available at a discount. India buys palm oil mainly from Indonesia, Malaysia, and Thailand, while it imports soy oil and sunflower oil from Argentina, Brazil, Russia, and Ukraine. The mystery of the disappearing Indian students. Indian students formed a significant portion of some 50,000 international students reported as no-shows at Canadian colleges and universities in March and April 2024. According to the Immigration, Refugees and Citizenship Canada, that's IRCC, of these, 20,000 were from India, representing about 5.5% of the total Indian students tracked by the agency. These figures were collected under the International Student Compliance Regime, which requires that educational institutions report an enrollment twice a year to ensure adherence to study permits. Students from some 144 countries were tracked, with non-compliance rates varying quite widely. Now, all of this is obviously not good news for Indian students who are trying to reach Canada for further studies, something that we've been predicting on the core report would get tougher in recent years. Experts in Canada told local newspapers that most non-compliant Indian students likely remained in Canada working while aiming for permanent residency. Some tried to or moved to the United States. This, of course, has drawn attention to the gaps in this system, which is being gamed. And one of the options being suggested is that international students pay fees upfront to prevent abuse. Hyderabad is running out of beer. The state government of Telangana in India, likely the largest beer consuming state, has not paid up United Breweries, which is controlled by Heineken, for the beer that it has bought from the latter. Thanks to which United Breweries has suspended sales of beer, including its most popular brand Kingfisher, to that state. This also reveals the interesting economics of alcohol manufacture and distribution and the role of state governments in it in India. So alcohol is bought by the state government and then supplied to shops in Telangana, where officials are now, according to rationing supplies to deter hoarding and tackle shortages, retailers told Reuters. One liquor store owner in Hyderabad told Reuters that today they got a notification from the depot that there is no Kingfisher beer stock anymore. According to Reuters, this is the latest sign of stress in India's $45 billion alcohol market, with companies like Diageo, Pernod Ricard, AB InBev, and Carlsberg together demanding some $466 million in unpaid dues. Telangana State last week said United Breweries had suspended supplies as a tactic to press for price increases, and a panel was deciding on such requests. Meanwhile, of course, depots are running out of beer, and the situation is dire for those who imbibe it. One liquor store owner in Hyderabad told Reuters some outlets had barely 10 days of Kingfisher beer stock remaining, while others had only 2 days. United Breweries is India's biggest beer company and accounts for 70% of Telangana's beer market, where 60 million 12-bottle cases were sold last year. The Brewers Association of India has struck back, saying that beer prices companies charge in Telangana are around 300 rupees per case, whereas in Maharashtra they get around 500 rupees a case. So in order to make sense of all of this, I reached out to Vinod Giri, Director General of the Brewers Association of India, which represents close to 90% of beer makers in India, and the big giants like AB InBev, Carlsberg, and United Breweries, of course. And I began by asking him why this matter had reached this stage in Telangana, and also a crash course in beeronomics.
Well, to start with, the matter of suspending supplies or continuing or restarting supplies, strictly a commercial issue between a supplier company and Telangana State Beverage Corporation. So what I will speak for the industry on the whole and not specific to a company. Let me clarify that first. What I can tell you is that I agree with the assessment that the prices being allowed or offered to the companies in Telangana are actually below the cost of production. And that is because of the simple fact that these prices are based on the cost of production which the companies had submitted in 2018-19. At 5 years is a long time, the costs have gone up significantly in this period. And because the prices have not changed, and so it's become a fairly commercially punishing to supply in the state. Sure, a company like United Breweries would have given it a due thought before they took such a major decision. It's entirely their decision. All I can say is that, yes, it's true that the cost of prices are below the cost of production.
Right. And this, I would imagine, affects brands like Kingfisher, which everyone would know. Now, my larger question a slightly larger question here is, how is the Indian market structured in terms of distribution? So Telangana is obviously a case of a state buying the alcohol from the producer and then selling it to those people who live in that state. Is this common across India?
So let's say there are four types of distribution networks in India. First is the open markets, like any FMCG product, and that's where you have states like Maharashtra, Goa. These states are of that kind. Then you have market which are auction markets, where basically the government auctions all the outlets and ensures that the revenues come right in the beginning of the year. And thereafter, the retailers or the wholesalers are allowed to do what they want. And typically, you have three states in the north: Haryana, Punjab, and Chandigarh, which follow this kind of model. A vast majority of states in India, and nearly 65 to 70% of the volume goes through them, follow a government wholesale and then retail model. So here the government works as either as only the wholesalers and then the retailers are private parties, or in some cases, extreme cases, and they are Tamil Nadu and Kerala typically, where the government also acts as a retailer. So the government has a full control of the trade. But in a majority of states, such as Telangana, Andhra Pradesh, Orissa, MP, West Bengal, Rajasthan, and all these states, the government acts as the wholesaler. So basically, the companies supply to the government wholesale, and they will have many depots and where the companies would supply. The retailers would come, pay the depot in a cash and carry mode, and take the product. So effectively, the day a retailer picks up their stock from a government-owned wholesale depot, the government has the money. The credit terms really kicks in from that day. So there is no reason. That's why many state governments actually pay you within 2 to 7 days. And vast majority of corporations like Kerala, Karnataka, they're very prompt. Tamil Nadu, because there's no reason. The money has been collected by the government already.
Right. Your association has said that the differential in price between Telangana, where there is a dispute, and let's say states like Maharashtra is fairly high. You've said that beer prices, or rather beer prices charged by companies in Telangana is about 300 rupees, which is obviously the limited price, whereas in Maharashtra they're getting 500 rupees a case. So this seems like a substantial gap.
Even in most other states, like if you take AP, which is a neighboring state, would be around close to say 440, 450, even though they also did not have a revision recently, but still the prices are much higher. Tamil Nadu would be the same price, about say a 450 range. Kerala, the other state in that southern region, is similar price. So the difference is say about 130 to 150 rupees is the minimum difference the nearby states have. Is anything more in other states?
I would imagine that this kind of differential obviously causes leakages.
So this is the differential to the company supply prices right now I'm talking about. It may not necessarily translate into the same kind of MRPs. The leakage happens on the basis of MRP. Yes, but Telangana MRPs also are low.
Right. And a slightly broader question. Now, we're talking about beer here. What's the proportion of beer sales versus in the context of overall alcohol? So, if overall alcohol is, let's say, $45 billion for India, what would it be for beer?
So, beer in India is relatively smaller form, and the contrast is evident that globally, nearly 68% of all alcoholic beverages sold are beer, whereas this number in India would be dramatically less. So even in terms of entire volume, it will be about 35% of the liquid sold will be the beer. The beer is underdeveloped, so no one denies. And liquor, IMFL and country liquor is the predominant form. They basically account for nearly 70% of the beverages sold in the country.
When you say 70%, you mean value terms?
The volume term, the value term would not be very different because the liquor tends to be on a per unit basis, same or more expensive than beer.
Right. And last question, how are you seeing seasonally? How are things for the industry? I mean, a lot of people obviously invest in stocks of alcohol companies, or at least some of them. So I'm sure they would also like to know, how are things looking like right now? Did what we discuss so far have any impact on how the company's profitability might be affected and so on?
Fundamentally, on the demand side, which is a more sustainable part of the business, there is nothing to hold beer back, and beer has been growing actually in the last 1 year about say 9 to 10% up. So that's a fairly healthy growth for a category which is so old. So on a demand side, there's no issue. Wherever we have concern, that's more because of the supply side. Like in Telangana is a basically supply side matter. Tomorrow, if and we hope and we are optimistic, given the reputation of Telangana generally as a very industry-friendly state, that this matter is resolved very quickly and the growth comes back. So, except for these aberrations here and there, I think the beer industry is pretty much on track for a good growth. Now, some of these issues, when they come up, they affect the industry in the short term, hopefully. We expect that the government now and the industry and the companies which are being affected, part of it, they sit together and resolve this issue quickly. Concern is because in a state like Telangana, which is a very big state, the largest for the beer industry, so industry cannot stay out of it. For the government also, there's no way if such a big supplier company goes out of the market, it's not easy to ramp up supply by other suppliers and make up for that. It's not going to be easy. Beer is a very high entry barrier industry.
And there's brand affinity as well. So people will obviously insist on certain brands.
And even in a pure product terms also, understand that the breweries take about 500 crores to invest. So it's not like a distillery, which is a small budget operation. So there are few players here. Capacities take time to build. And this kind of investment, no one does for the one rainy day. I might need that supply. It's a big investment for me. So that also, so the state will suffer, the industry will suffer. So that's why we are very optimistic and we hope that this matter is resolved very soon. And so the by and large industry remains on the growth track. It is right.
Right. Vinod, thank you so much for joining me.
Thank you very much.
Decoding India's trade numbers. There is a problem with India's trade numbers right now. The numbers for November were wildly off the mark because gold imports were overcounted and overstated, creating a cascading effect of errors on all trade data. So the latest one shows that India's trade deficit has narrowed to about $22 billion. That's for December 24 from its record high level of $32 billion in November 24. So the narrowing was led by sequentially lower deficits on account of gems and jewelry, petroleum products, as well as core items. The highlight, of course, was that sharp revision to the last few months of import data for gems and jewelry, and that statistical reconciliation has pruned the cumulative merchandise trade deficit by about $9 billion between April and November 25. Now, here's the interesting part. Despite the reconciliation and correction, gold imports into India are still at a record. And there's a good reason for that, and you should hold on if you want to find out why. Economics research firm QuantEco says two developments that could also potentially impinge upon India's trade deficit in 2025 would be the impact of fresh sanctions by the United States on Russian crude and the anticipated imposition of tariffs by the Trump administration on key trade partners, which could start as soon as next week. I reached out to Vivek Kumar, economist at QuantEco, and I began by asking him to tell us how he was looking at the new set of trade data, to explain it to us, more importantly, and what we could take away from it as an aggregate.
As far as the surprise element is concerned, it was actually not a surprise if you think about it, because the media reports with respect to the data revision after the outsized number which was reported for November had been around for some time. Last week, the Ministry of Commerce came out with a press release stating that they are revising their numbers lower. So now the official press release, when it was supplanted with the data for December, is kind of corroborating that. And the sense is that the overall trade gap is now lower by almost $12 to $13 billion. And a large part of this is on account of correction in gold data, which is of the order of $8 to $9 billion. In some sense, the downward revision is being led by precious metals. Now, the statistics part of it, now looking at the overall question that you posed, while it is comforting that the fact that trade deficit is not as wide as what we were fearing initially or a month back, the point to note here is that gold imports are still elevated. The data for the month of November, which is for precious metals imports, still continues to be at an all-time high. So this is despite the sizable downward revision, you still have the numbers which are extremely elevated. $11.6 billion is the total import figure for November. That is at an all-time high.
So what is that figure, Vivek?
So it's $11.6 billion for the entire gems and jewelry space. And that's an all-time monthly high.
Okay, so that's a useful takeaway. So why is it?
So there are a couple of reasons why what appears to us at a broad level is that there's a humongous degree of price impact.
Any thoughts on why this is happening?
So what appears is that there is a significant degree of price impact. So if you average the price of, let's say, within the precious metal basket, if you look at gold and silver as two major commodities, these two commodities have risen by almost 26 to 27% between April to November of this financial year compared to April of November of the last financial year. So this 27% increase in the precious metal prices is getting reflected in your import data. So the sense is that predominantly it's a price impact rather than a quantity.
How are you seeing exports? So in your report, you've said that you're somewhat surprised by the contraction in crude oil exports.
Correct. So we are surprised on account of both crude oil as well as gems and jewelry exports. So crude oil exports are down almost 21% on financial year till date basis. That's huge drop, considering the fact that your crude oil imports are not showing that kind of correction. In fact, in contrast, they are down by only about 6%. So there's a mismatch between how crude oil imports are performing and how crude oil exports are performing. Now, if we do a cross-country analysis, the major culprits in terms of where our crude oil exports are going, where you've seen deceleration in terms of growth momentum. The countries within the top 5 basket are Singapore, Australia, and these are the 3 major countries where our crude oil exports have shown a marked deceleration or in fact negative growth this particular financial year. Similar is the story on account of gems and jewelry. Our gems and jewelry exports have contracted by 12%, whereas our gems and jewelry imports, despite the downward revision, they have expanded by 7%. So there is the dichotomy here vis-a-vis both crude oil as well as exports and imports performance.
It's interesting that we are exporting crude oil because otherwise we are a net importer, or we import 80% plus of our requirements of crude oil, isn't it?
Yes, so the number is fairly small, you could say, but still it ranges anywhere between 10 to 20% of our total export basket compared to the import. So 10 to 20% share in the export basket is not small per se, but vis-a-vis the share that crude oil has in the import basket, it is lower.
So as we look at all these figures, so where are we in an overall sense of merchandise imports and export? I mean, how is India's trade doing right now? If I were to ask you a more 30,000 feet question.
So in terms of overall sense, so far, the run rate is still higher. So if you see how the deficit has performed between April and December, last year we clocked $190 billion in terms of deficit. This year, April to December, we have clocked $211 billion. So you could say that there is a delta of $20 billion that has accrued over a span of 3 quarters. Now, if you extrapolate to the remaining quarter, which is one more quarter, you could possibly see another $10 billion or so adding up to the trade deficit. So our sense is that we could end the year somewhere close to $270 odd billion on trade deficit.
And when you say end the year, you mean the March 31st?
March 31st financial year, correct.
Right, Vivek. Thank you so much for joining me.
Thank you so much, Govindraj.
It's Friday, so here's some feedback. And this is the segment that I always look forward to because it gives me an opportunity to relay what you are saying and also, of course, reflects the effort that you're putting into penning these thoughts. So let's start off with Ocean Star. Good to hear from you again. Thanks. And he says that, or she says, tax liability should be determined with pinpoint accuracy down to the very last rupee. If I'm at the lower end of the 30% slab, why am I paying the same rate of tax as the guy at the top end of the slab? The liability should be determined at the individual level. The tax slab method in this day and age seems very archaic and redundant. Back in the day, we did not have the means to compute or the computing power to determine taxation accurately. Therefore, the slab method was appropriate. We now have had massive leaps in computing power for a couple of decades now. Excellent point, I think. And this, of course, plays to the larger conundrum of whether the government will lower tax rates or make it more attractive, because there is a very strong call in order to put more money in the hands of consumers. Neeraj Palla says, fabulous analysis by Rama Bijapurkar. Abhijit K. Rao says, Mr. Choka, that's G. Chokalingam of Economics Research, is one of my favorite stock analysts. Yes, we like him too, which is why we keep inviting him. Well, that's it from me as far as feedback goes. I hope you had a great week and have a good one coming up too. See you soon. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.